Hey everybody, it's Tyson Stracks here with the Hockey Wealth Group on Monday, August the 28th of 2023. I did want to announce something exciting. Today at noon, our fourth podcast will be available anywhere you listen to or watch podcasts. So you can watch it on YouTube or Spotify, or obviously listen anywhere that you listen to them. And the guest for this podcast is Braden Holtby, an awesome guy with an amazing career, a bookshelf full of awards, and a really down to earth, great guy to talk to, listen to. Quick and easy, 22 minutes, some great advice, great conversation. And then today I did want to spend a little bit of time discussing sample periods um, as they pertain to investment options. So, and I want to say that you need to beware of these sample periods. And we do have some data. This comes from this kind of topic. A recent article put together by Dimensional with data going back to 1927, so almost 100 years of data, shows that on average, the S&P 500 has returned 10.1% per year on average. During that exact same time period of almost 100 years, U.S. small cap value stocks have returned 13.1% on average per year. So a full 3 points of outperformance there. The reason that if you are a news taker, etc., following CNBC, etc., that you probably aren't hearing about this, it's kind of boring. For the most part, these are these names of companies are names that you have never heard of. And we would say that the best way to own these names is through using low-cost diversified ETFs. That's exactly what we use for our clients. And realistically, again, this isn't a narrative that sells in the social or in financial media, right? So what's best for you often doesn't sell, and that's not just in financial news, but all news really. But again, if you're going to be watching a CNBC, etc., I guess I'll pick on them today. But you're going to be hearing on a day-to-day basis stuff like buy Apple, short Google, use a long call butterfly option. And these concepts they sell you on continuing to watch, to continue to subscribe, buy books that they are putting out. Whereas using a low cost ETF to gain these small cap exposure just isn't a big selling point, right? So to keep building on this, many of these short term strategies that you're going to hear about through the news, etc., like the option spread or short this, go long on this, etc. Many of these strategies are built around, 1 month, 1 week, even 1 day sample periods. And some of these day trading techniques, which realistically we would consider fraudulent, they would never work. They are meant to keep you coming back every single day, taking in their narrative, their news, and they're just trying to sell that content. Whereas, again, looking at this long-term data, 100 years of data, you're going to see that there is data, stating that a rational investor would at least want to have some small cap value in their portfolio. We would even argue, if you're looking at this almost 100 years of data, right, that using even 10-year sample periods is too short. And a great example of that, actually over the last just over a decade, pretty much 12 years, the S&P 500 actually outperformed small cap value by about 1.7% per year. But it's also easy to forget that the decade before that, so 2000 to 2009, also known as the lost decade, during that decade, if you were only invested in the S&P 500, you would have actually lost money. Whereas during that exact same time period, US small cap value returned on average 12.3% per year. So you would have doubled your money being invested in that just over that decade. Or if you were in S&P, you would have lost money. So using these short little sample periods to illustrate different trading patterns, etc. Again, the news media, the financial media is going to continue to put out things that are short sample periods that support you coming back time and time again, day after day, day after day. And we would say, beware of that. Look at these long sample periods. And yeah, be careful with the sample periods, recency bias, etc. And then also quickly, last week we saw in the equity markets, they were pretty flat. More interesting, fixed income. We did see the short end of the yield curve continue to rise, and that basically came off the narrative coming out of those Jackson Hole meetings that I talked about in last week's video, where the Fed came out of those meetings with a little bit more hawkish tone than markets expected. And then last thing, as I said, it's August 28th, almost to September, which puts us just 2 weeks away from our fall reviews. If you haven't signed up for those yet, and you do want to speak with us, please do sign up for that sooner than later. And I think I mentioned it a few weeks back, but don't feel forced into it. If you feel better about only meeting once a year, etc., that's fine too. But if you do want to have the meeting with us, please do jump on and sign up. All right, so enjoy Holtby's podcast today, and look forward to talking to you soon.